Hi, everyone, and welcome to Cultivating Business. I'm Kevin McLaughlin, Managing Director with Centri Consulting, where I lead our cannabis practice. We have an awesome guest today who wears many caps, has a lot of skills. He's got experience as an investment banker, in M&A, restructuring as a CFO, and has some great knowledge within the cannabis industry. Our guest is Hershel Gerson. Hershel, thanks for joining us.
Thanks, Kevin. Pleasure to be here, and thank you for having me on the series.
Yeah, absolutely. Looking forward to it. So why don't we jump right in? Always like to get a little bit of background about our guests, and how you got into the industry and how you fit in the cannabis industry currently.
Sure, appreciate it. So I got into the industry in 2019. Previous to me making my foray into the industry, I'd spent 20 years in investment banking, predominantly 10 years at Credit Suisse, and then had gone to a number of institutions, BNP, Macquarie. And at Macquarie, where I was co-heading the consumer business, I was looking for something more entrepreneurial to do, potentially get out of the large banks and kind of do something on my own, and had a interest in cannabis. Had been a participant in college and for a large part of my life, and saw the opportunity associated with the cannabis industry. So in 2019, with a partner in MGO, we formed LO Capital, where I was CEO and built a 15-person organization to provide advisory services to the cannabis industry. Once COVID hit, we made a decision to merge that business into a more natural fit, Roth Capital, where I co-headed consumer there, and made a decision as the equity capital markets were kind of falling away and cannabis was going into restructuring, and seeing the professionalism that was necessary within cannabis, forming a partnership with PGP Capital to start a restructuring and advisory effort. Our other partner, Richard Orman, is a leader in the cannabis alternatives to bankruptcy. So Article 9, ABCs, as well as receiverships. So we felt between Stuart Kim, who's the founder of PGP, myself, and Richard, we could do a lot to help the cannabis industry as it goes through this transition period. And then in addition, cannabis companies need a lot of professionalization. I was a CPA formerly before getting into investment banking, and I put on my CPA hat to provide CFO services as well. And today I'm also the acting CFO at Fohse, which is a leading LED business to provide the leading LED fixtures to the cannabis industries to help cultivators grow at the lowest cost possible.
Yeah, absolutely. And as you can attest to, and you alluded to in over the years here in cannabis, it's been a bit of a roller coaster, but awesome how you've kind of evolved and seen it grow to see how you can help folks. And we'll get into some of the things as we chat here, but all good stuff. As we look to the beginning of the year 23, there was a lot of discussion about challenges that were happening, where there may be opportunities in cannabis. How has that evolved in the first half of the year? And where do you see that playing out, as we look to the second half of the year as it relates to the industry in its current form?
Yeah. Look, as I mentioned previously, a big reason for forming the line or coming to PGP Capital was, I could see restructuring in the horizon for cannabis. So there was a lot of capital put into cannabis, but with taxes and other issues within the cannabis industry, there wasn't a lot of cash flow or profitability in the industry. And without any kind of changes to regulatory environment to allow for institutional capital was also drying up. So without private capital seeing the returns that they kind of modeled initially, there was a lot of people losing money, unfortunately. in cannabis. In addition, we saw resets in flower prices across the board in all mature markets. So we saw flower prices in California drop from 2,500 a pound for indoor to 1,000 and lower. So in other markets like Michigan, you saw it go all the way down to $600 per pound. And that forced people to very much have to focus on their operations and their cost structure to survive and make changes within their own organizations, given the new environment. And those that were willing to make the changes earlier were the ones that could kind of withstand the pressures that are in the industry. So that's a kind of a long way saying that, today or initially in cannabis, everything was growth. Grow the top line, expand footprints, do what you need to do to ensure growth. And today it's much more profitability. And what that means, as the revenue bases have shrunk, as the cost of cannabis or the price of cannabis has come down, that you really got to focus on your cost structure, your SG&A, and make sure that you're profitable and you can generate cash in a manner to withstand the current environment. So, that's that's a different mindset and sometimes very challenging for management teams to digest, I would say, from where what we all expected from cannabis, and we all came from cannabis. So and a lot of that is I think one of the biggest factors right now in the industry is the taxing authorities, and that could be either your state and local to the federal 280E. Those two constituents have a lot of leverage relative to your licensing and your ability to continue to operate amongst all the other creditors.
Yeah, and I think you made a good point that, as it's evolved here, bigger isn't always better. It's, you're seeing a focus on these businesses getting better, becoming more profitable, operationally becoming more efficient, so to speak, versus just, growth. Obviously, that's we've seen that over the last year plus, and I think we'll continue to, and probably for the best as we look forward here. So
yeah, I would say one other thing related to growth, and which is a shift as well. As people look at multi-state operators, which was a key word 3 years ago, I believe there is some dyssynergies associated with being a multi-state operator, and that goes across, like, packaging doesn't necessarily meet all regulations in different markets. So you have different packaging requirements. Different markets have different limits on THC percentages. So SOPs can be different in relative states. Product sets can be different. So and then just the regular how you operate, whether you're strong in retail. Some states obviously don't allow you to be vertical. Some states limit your retail, so you have to be stronger wholesale, have brands. So it's a very tough environment to operate in multi-states with different regulations and so forth. So some of the most successful operators are the ones that have gone deep in a few states versus trying to be everything to everybody in multiple states. So that's another kind of difference that we've seen evolve over the last few years as well, especially in this environment.
Absolutely. All good thoughts and insights, and interested to get your thoughts here. I think as you think of the challenges and where things are, there's certainly businesses that are struggling, and it's been well documented they don't have the same federal bankruptcy options that businesses in other industries have. How do you see this? How do you see that playing out? And would love to give, with your background, some insights on the importance of restructuring, as I think it's near and dear, and we're starting to see quite a bit of it here, just given the state of the industry.
Yeah, and it's something we've been involved in pretty extensively. So everything from CCAAs up in Canada
Mhm.
to assignment for the benefit of creditors, ABCs, Article 9s, and receivership processing. So what I would say is, given there's no federal bankruptcy, and CCAA, which is a Canadian, essentially the Canadian federal bankruptcy code, is limited as to what benefits it can have in the US. So you're really looking at state by state and running through ABC receiverships in Article 9. And there's not one of those alternatives that necessarily fits all cases. So it's a case by case basis as to what we recommend as the best course of action. And that relates to what your capital structure looks like, how many stakeholders are involved, and so forth. So generally, as we look at the three alternatives, having somebody walk through those and look at your capital structure is generally really important to get the best outcome for the company and this relative stakeholders. What I've also seen is, and what we're experiencing is, it's really hard. Look, and I totally get it. Founders, they put all their blood and sweat into it, all their resources into it, financial wealth, and so forth. To go into restructuring is not an easy alternative, and you're always hoping to be able to come out the other side. But what we're finding is that whether they're extending AP or not paying the brands or not paying the tax authorities, the how the company performs, it can be dramatic. It can be dramatic in the end, and the acceleration of the decline in the business can be significant and accelerate in the back end. So what we see is they extend as much as they can terms the brands and so forth, and they'll just say, oh, I just need a bridge or a band-aid to get to over this trough and make it to profitability, or that a sustainable place. But what they're not taking into account is they've extended their brand so much that their menu is going to decline significantly in the near term, and that's just going to accelerate more degradation on the customer side, and then it's just a death spiral. So the current state of operations is going to decline potentially precipitously. So you could see that in herbal, where they started extending the brands in California, and then the brands just looked for alternatives very quickly and went on consignment or wouldn't give them more inventory. And then it's just almost like a run on the bank, where there's just no product to move, and then and then the train stops very quickly. So one of the things we talk to companies is doing something before you have to do something, because it can be too late at that point, and then you're looking at potential liquidation options, and that's something potentially that's going to happen with Skyman in Michigan, which was a thriving business, potentially waited too long, and now looking at liquidation alternatives than just a restructuring. So these are things that we talk to folks about to get out ahead of the restructuring than waiting to the last minute to do the restructuring, because things will happen quickly and the decline in the business can be dramatic very quickly as well.
Yeah, I mean, to your point, Herbal, that happened like that. But it's not easy, right? To have that proactive mindset when someone, you're talking a large investment or blood, sweat, and tears and all those things. But I think now you're seeing some writing on the wall of situations where people kind of waited it out a little too much, and there's really nothing left. So I think that'll continue to be. You'll see more of that. But wanted to get your insights as well, and it kind of piggies back off of that discussion. And that question is, we have started to see more businesses that are going through the receivership process on the state level in the U.S. What are some key considerations to think about for businesses as they assess it as a potential option? I know you just hit on it a little bit, but anything else specific to the
Yeah.
receivership process in terms of like key thoughts, key considerations?
Yeah, in my mind, receivership is a last resort. So generally, the receiver is being put in place by the senior secured or other stakeholders other than the equity. What we talk to folks about is going through an ABC process, which is a kind of negotiated process in advance of inserting a receiver. Because generally what happens on the receivership is your senior secured or your lenders or another investor essentially goes to the courts, and the receiver is appointed by the court into the business, and they effectively control the operations of the business. An assignment for benefit of creditors, or an ABC process, is basically you are trying to negotiate with all the stakeholders to, and there could be a management change, but basically management and the founders, assuming they're still involved, they're going to the constituents and trying to negotiate, and the other stakeholders trying to negotiate a settlement where you may give up some equity, most likely going to give some equity, convert some of the debt to equity, but that at least provides you some ability to continue to control the process versus having a third party come in and kind of tell you what you need to do in those situations. So it's a precept to doing a receivership process. Once the receiver is inserted, you're really talking to another stakeholder in the business and the receiver, and getting somebody in there as a receiver who can quickly stymie the negative cash flow, kind of try to restructure the business in a quick fashion in order to preserve a going concern, right? Because that's ultimately what you're looking at when the receiver is there, is to maximize value for the stakeholders. And generally speaking, 9 out of 10 times, that's going to be able to maintain a viable going concern operations versus just trying to get what you can for the assets and liquidating the business. That's probably your lowest value in the business, and maintain that going concern. Now that can be challenging because generally those businesses are so much in the hole that they need some capital or cash infusion in order to alleviate the pressures from your AP, the tax authority, and so forth. So it can be challenging to get out of that downward spiral at that point, because it's a public process as well. So everybody knows, right? All your
It's all out there. It's all out there.
customers know, the brands know. So everybody knows you're in receivership. That is a very public process. That's the other thing. So that, everything stops, right? Nobody's going to give you more product because they're concerned about getting paid on it, because they're basically unsecured at that point. So whereas an ABC, again, is a very private process, and you don't have to go through that public disclosure, essentially. So it's a little bit easier to deal with folks.
No, that makes sense, and no, I appreciate all that. I think it's, like I said, there's going to be more of this, hearing and learning and getting more insights on this topic. Certainly beneficial. Hope everyone enjoyed learning a little bit here on this. And I always like to end with a prediction. Again, I won't hold you to this, given just where things are. But what's a prediction you have for the industry, for cannabis industry, as we look for the last 6 months of 2023?
So look, I believe, and I don't know if it's 6, I think it's a little bit longer than 6 months, but there is what I think is going to happen is you're going to see consolidation within the states. So we talked a little bit about the dyssynergies of being a multi-state operator. I think what's going to ultimately happen is each of the states are going to have a few players that basically control the state. So you can have an oligopolistic situation, which then will preserve prices and margins and so forth. And it'll go, in my mind, state by state, because there's just too many dyssynergies to be a multi-state operator. And we're seeing that. And how long that takes depends on, it's going to happen pretty quickly because there's no capital. So once people come to the realization that it's going to happen to them, that's when consolidation or people are just going to liquidate. To alleviate that, obviously, people are looking to the black market, and they'll do,
Mhm.
scratch and claw as much as they can. And, I don't blame them, again, for what we said about founders and all their blood, sweat, and tears and all their money in there. But generally that's what I think is going to be the outcome. And I don't know, safe banking. I don't rely on Congress or the federal action. I just don't think they necessarily care. I don't think they feel they're going to lose or win votes in a
There's not
dramatic
enough,
fashion.
there's not enough
There's
on the
no
table.
catalyst.
Yeah,
Exactly.
not enough on the table for it. And I think everyone was a little more optimistic on the federal level years ago, which is why you saw the MSO push. And now they're like, okay, this could be long, a lot longer here, which, to your point, I think you're going to see, and you've already seen some of the MSOs like getting out of certain, they're getting out of markets. They're, closing up shop. So yeah, I think you'll start to see.
I don't want to point out any specific ones, but yeah,
No,
you're seeing
but people read the
pull
news
out
and-
of states that are unprofitable and invest heavily in states where they have some depth or they have pricing, like New Jersey, where there's $4,000 a pound, or Maryland, right? They want to extract as much value as you can while those markets are opening up.
Absolutely. Well, Hershel, thanks for joining us. Awesome as always chatting with you. Really, really appreciate it. And look forward to seeing you soon.
Yeah, thanks a lot. Thank you for having me, Kevin. And always loved working and do love working with Centri. So thank you very much.
Awesome. Appreciate it. And thanks everybody for tuning in. We have another great episode next month, so stay tuned and please join us on the next episode of Cultivating Business.